In today's video, I'm going to teach you why it's important to wait for good entries in forex trading or crypto trading or stock trading or any type of trading you're going to be doing. We're going to be talking about what a good entry is in forex trading in particular, and we're also going to be discussing these 5 reasons you see on the screen as to why this is important. So, as usual, I teach all of this for free in my free training course. It's completely free, it's very comprehensive, and it's very simple. It's at the link in the description if you'd like to join that free course to be able to learn exactly how I trade, so that you can go through and examine all these things I'm going to teach you here in this video and just do so in more detail. Without further ado, let's get started with this first reason. So the first reason why it's important to wait for good entries in trading is because you get a better risk structure. Now, let me be very abstract first here. What we're going to be doing is just using this little path tool here on TradingView to illustrate this. So let's say, for example, you find a resistance zone that you think price might bounce at. And on the higher time frames like daily and weekly, price has bounced here a couple times. So as price comes up here towards this zone, you think that if price gets there, it might bounce downwards. And how would you profit from something like this? Well, it'd be very simple. You would sell at the resistance zone, stop loss would go somewhere above the zone, and the target would go somewhere below the zone. So with this being said, what happens to your risk structure if you enter right here? Right now your risk reward goes from a positive risk reward to like a negative. Now you have to have all the way down here just to be a 1-to-1 risk reward. Well, what happens if you wait for price to get here into the zone, right? To where it just gets into the zone. Well, now your risk structure looks something like this. You have an entry there, you have a stop loss above the zone, and you have a target somewhere below. So you can at least get a 1-to-1 risk reward ratio. This is good. This is better. But what happens if you enter and then price goes up here a little bit further into the zone, right? It's going into drawdown, but it hasn't broken the previous highs or any wicks past the zone. And so you wouldn't want to get stopped out of that trade. And it could really even go a little bit further and still technically be valid before falling and turning over. What happens if you wait for an even better entry? What does that mean? It just means that your entry is as close to the moment where price is either going to break the zone or bounce at it, to where your stop loss is the closest it can possibly be, and then the potential for profit is at least a 1-to-1 risk reward ratio. What happens if price comes up a little bit further into the zone right here? Right, literally around the most recent high. So you have like a set of maybe highs that are extreme right there. Well, now if you enter right there, but you have the same stop loss with just a 1-to-1 risk reward ratio, price barely has to have a move off of the zone. And then this allows you to get your profit target hit very, very quickly if it works out. And if it doesn't work out and it breaks the zone, the worst case scenario is you get your stop loss hit. Stop loss really only exists as as kind of like an emergency type of situation. Many times if price goes and starts breaking above a zone or ranging at it and going up, you can close before the stop loss. Thus, your losses are smaller than your winners. But this, in short, is why it's important to wait for good entries and not letting price do things like this in entering, where it comes up barely into the zone, hits the zone, and then it starts going down away from the zone. And then as it's going away, you then enter down here. Now you're entering all the way down here. To even get a 1-to-1 risk reward ratio, you have to have your profit target all the way down here. And it causes a lot of these things that we see here in the 5 things I'm talking about here in this video today. So the first thing is that you get a better risk structure, right? Whenever you're entering here at the zone with a stop just past it and a target of at least 1-to-1 risk reward ratio, regardless of the market that you're trading, it is in fact a better risk structure, because you're saying, here's the point of invalidation right here above the zone. The entry is at the zone, meaning inside the zone, and the profit target, even if it's just a 1-to-1 risk reward ratio, which is what most of my trades are. And keep in mind, I've been trading for almost a decade, and I've made millions of dollars trading forex, crypto, and stocks combined over that time period. I still use 1-to-1 risk reward ratio. It's very simple. There's nothing complicated or crazy or insane. You do in fact get a better risk structure by entering at zones with a stop just past it and then a nice little profit target. The second thing here is that you get a shorter trade duration. What does this mean? A shorter trade duration just means the trade doesn't take weeks and weeks and weeks and weeks and weeks to play out. A lot of my trades only take a couple days to maybe a week to a week and a half or 2 weeks, right? So anywhere from like a day to 2 weeks max, but really most of my trades are closed within a couple days, meaning like a week or less. And that's a trading week or less, meaning 5 days or less. And what I do is I just wait for these really good entries where they're right there at the zone at the make it or break it moment. And I just wait and wait and wait and wait and wait until price gets deep enough into a very clear support or resistance zone before I enter a buy or a sell respectively. The shorter trade duration also means that you're going to be paying less in fees. You're going to be paying less swaps. The commissions will be the same, but you're going to be paying less swap fees and holdings fees. And then if you hold the trades over Wednesday, you get charged triple swaps, which means like if you have a trade that would have cost you $1,000 in swap fees, it costs you almost $3,000 on a Wednesday, because Wednesday is when you do the session changeover and it counts Saturday and Sunday as well. So if you're holding trades for weeks and weeks, swap fees will really eat into a lot of your profits, especially when you're a high volume trader like me. For my trades, I risk anywhere from $25,000 to $100,000 per forex trade that I take right now. My average risk is about maybe 50K per trade, but I risk anywhere in that margin for trades. And when you're using position sizes that are that heavy, such as like 50 to 100 to 150 lots or more per trade, the swap fees can add up. By waiting for a good entry, you have less time spent in the trade, shorter trade duration, and thus lower fees in terms of swaps, which starts to really matter when you're trading high volume. The third thing here is that you get asymmetric risk reward. Now, I already talked about this for a second up here, but getting asymmetric risk reward whenever you're entering a trade that is not quote unquote good, meaning it's not inside the support resistance zone you think price will bounce at. This just means that to even get a 1-to-1, price has to go all the way down to here. What if we did not change the stop loss or the profit target and we just changed the entry, right? We just said, if it goes down from here, fine. We're not going to enter right now. But if it just so happens to pop back up and go deeper into the zone, then we'll enter there, right? So then let's say that does in fact happen. Let's say it happens to pop back up. You thought it would drop from there, but it didn't. It paused and then it went right back up, and then you're able to enter up there. If we do not change the stop or the target at all, we just change the entry. Look at the risk reward. It's 1 right now, 1-to-1. We put it up here. This is now almost a 1-to-3 risk to reward ratio. So with the same profit target and the same stop loss, you now have 3 potential units again for the same 1 unit of risk, just because you waited to enter here at the zone instead of down here. Okay. This is why, generally speaking, you get asymmetric risk reward if you do this. And then if you're like me, you just don't even play the game of trying to target 1-to-2 or 1-to-3. Most of the time you just target 1-to-1 risk reward ratio. Look how quickly you're out of the trade. If you would have entered down there, but instead you just waited for price to get up here and you set a 1-to-1 risk reward ratio, if it just pops right back down there, instead of being break even after having gone into drawdown and the trade took 2 weeks, now you enter, and if it bounces immediately, what happens is it goes straight to your profit target. Your profit target was the entry as to where you would have entered with just a 1-to-1 risk reward ratio. Your profit target is just so quick. These things just play out so quick, so much more quickly, and they tend to actually work way more consistently on the higher time frames like daily and weekly. So asymmetric risk reward, if you did want to have the same profit target, it was almost a 1-to-3 risk to reward ratio by changing not the stop loss and not the profit target, but just the entry when compared to a lower quality entry that is outside the zone with a wider stop. So that being said, the next thing is you get a higher risk per trade. So if you know that most of the trades are going to work out more often than not, and if you also know that if you're just doing a 1-to-1 risk reward ratio because you're not trying to justify the lower win rate with a huge risk to reward ratio, what that means is you can risk larger portions of your account per trade. Now for me, the way it looks for my account is I'm risking anywhere from 10 to 15, sometimes even 20% of my account per trade. Right now, the account that I'm trading on just crossed $500,000, and now we're in a little bit of a drawdown right now where the actual equity is sitting here around $465,000. But just last week, I made $20,000 on this account. The week before that, I made $130,000. This week, this is the first trade that was closed and lost. I lost $25,000 on that trade. And again, I'm doing the same things, right? I'm just entering at resistance zones, stop above, target below. And earlier this week, this account was up to, it looks like 520,000. All this came back, went to drawdown, CAD JPY stopped out. And now I'm in a couple more trades right now that are starting to look like they're going to work out. NZD JPY, AD JPY. But with this being said, with my account being up here and I'm risking $50,000 per trade on average, right? I'm risking about 10% of the account per trade. You cannot risk 10% of the account per trade if you have a win rate that's significantly lower, right? If you're using 1-to-2 or 1-to-3 risk reward ratios, even with dynamic trade management and closing trades early, there will be times where your win rate is like sub 30%, right? You're like 25 to 30% on average. If you're losing 3 out of every 4 trades with a 25% win rate, it just makes it really, really hard to risk a lot of money because you're going to have losing streaks with a 25 to 30% win rate. All the time you're going to have losing streaks. And sure, whenever you're right and whenever you win, you'll make more on the winners versus what you lose on your losers. But if you're having any lower than that, like 25 to 30% winning rate, then what that means is that long term, you do not have a statistical expectation of making any type of profit. And that gets very, very difficult, not just statistically, but it also gets difficult emotionally to be able to just lose trade after trade after trade and just be frustrated as hell. That's why I just don't play that game. Okay. So with that being said, I just wait for trades like this, knowing that worst case scenario, I have a 50% win rate and it's just going to break even long term if I just hold the stop loss or take profit, because half the time it'll go up, half the time it'll go down. when you start adding in context, like really good entries at really clear zones that have a likelihood that's, where you think it's really going to bounce, you think there's a really high probability it might bounce, and then you're only using a 1-to-1 risk reward ratio. And what's even better is that you're just closing trades early if they break the zone. Then you're not even getting your stop loss hit half the time. The other half the time it gets hit, it's a small loss. But the other half the time it doesn't get hit. You lose maybe half of whatever you were risking. But whenever it wins, you have a full profit target. So you're making more on your winners versus what you lose on your losers, even with a 50% win rate and even structuring the trade with an initial 1-to-1 risk reward ratio. This is beautiful. This is so beautiful because it means that now you, instead of risking 1% per trade, you can risk 5 to 10 to 15, maybe even 20% per trade, depending on what your risk tolerance is and what your goals for the account are. For me, even with a lot of capital in this account, right? Right now, the account sits at $465,000 in equity, right? I'm still risking anywhere from $20,000 to $75,000 on average per trade, just sitting somewhere between 25 and 100K. So like maybe 50K, 60K, 75K per trade, somewhere in there. And that's 10 to 15% of this account. And yet I've grown this account from $250,000 all the way to $500,000. And I've done it live here in my Discord server over the past like month and a half. Maybe it's almost 2 months by now. So I pretty much like doubled an account in about less than 2 months just by trading this way. And it's just simple bounces of support resistance. There's not a lot of work to do. I just take maybe 2 to 3, sometimes 4 trades per week. And it's just very, very simple and straightforward. So with this being the case, you have better risk structure, shorter trade duration, asymmetric risk reward, and you can risk higher risk per trade. And the accumulation of all this means that generally speaking, you make more profit. And all you have to do is simply wait for good entries. Good entries is simply waiting for price to get all the way into the area that you think it's going to bounce and then entering there with a stop past that area and a target, in my opinion, of at least just 1-to-1 risk reward ratio. Especially when you're starting out, that makes it very nice and simple. NZD-JPY is a perfect example of this. This one's going into a lot of profit, and I wouldn't be surprised if it hits the profit target today. On the weekly chart, I had this zone marked up. I had an alert set at the zone, and I waited for price to get to the area where most of the other little highs were bouncing at. So this is on the weekly chart. Whenever I go into the 1 hour to get a closer look, we can see that price had bounced a lot in the past, literally all the way a couple months ago. Here, 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 a little bit of a dip above the zone, here, and it came all the way back, bounced here, and now it came all the way back and bounced here. So I had a plan to risk $25,000 on this trade, and then I had an alert just above it, the next high up here, to add another $25,000 of risk if it went up there, because now that it's at a better entry, as long as it doesn't break past the zone, it's still perfectly fine and it's a viable trade. So with that being said, I entered here. Look how quickly it's gone into profit. This has taken 2 hours to start going into profit, and it's even more profit than it was here. I'll show you where I started this position. This was at 8:49 a.m., so almost 9 a.m., Right now it's about 10 a.m. So it's been just over an hour since I entered this trade. And this is what it looked like the moment that I entered, right? So I have all my positions layered in here. It's almost 100 standard lots. This is what it looked like on my terminal the moment I entered down here. So 10, 45, and 45. This is about 100 lots on NZD-JPY. And then from the moment I entered, it started going into profit. And then now it's gone into more profit since before I made this video. And now that I'm on this video, you're seeing live, it's just dropping into even more profit. If this wins, it'll be $25,000, and it could win here in the next few hours. We don't know. We have no idea. Same thing with AED-JPY. I waited for price to get up into this zone. And when price got up here into this zone, the first time last week I sold, it bounced down. I closed in profit. I waited for it to get back up into this zone. I sold again right here. Started to go into profit, then it bounced and went up higher. And then when I went to the next high, which was the most extreme high of this zone, the make it or break it moment, I ended up selling again whenever price got up here, or a little bit below that, but like still, it's currently in profit right now on both entries. So now it's all going down, and I've added, and I've been able to get like really good entries here. And now if this goes down into profit, right, I'll be making a lot of profit on this one. It doesn't always work though. CAD-JPY is an example. I entered it yesterday, and I entered right here at the tippy top of this resistance zone. You can see on the weekly chart, there's all these highs pushing up really far into this zone. It was literally a perfect entry. Everything about this trade was perfect, and it still didn't work out. That's what risk structure is for, and that's what a stop loss is for. But I still waited for a good entry, and look how quick the trade concluded. So if I would have entered down here, right, around that first high, this is 1 week, 2 weeks, 3 weeks, 4 weeks, and it didn't work out. So a month holding the trade and it stopped out. By simply waiting for price to get right here into the extremes of the zone, at the tippy top, right, wherever like the stop loss would go just past the zone. By waiting for that, I was able to enter yesterday. And then yesterday after I entered and it started to go into profit initially. So my trade basically looked something like this. The entry was right there. started to go into profit, and then it pushed up again, into the zone, broke through last night, ended up hitting the stop loss. Now this trade, instead of taking 4 weeks to play out, which is an entire month, it took 1 day to play out, and I was out at a $25,000 loss, and it wasn't a big deal. This is the trade that I called yesterday. So I called it yesterday, so 11/18. So sorry, this is 2 days ago. So this was Tuesday, November 18th at 12 p.m. pretty much. So I called this out here. You can see what it looked like. It was right here. The entry was at the highs. There was 25K. If it would have worked out, it would have been a super quick profit target, right? It would have been hit very quickly. And that's what it looked like at that moment. The account equity at that time was over $500,000. And then what happened is it started going into profit originally. You can see right here. This was that same day, went into profit. And then what ended up happening is it didn't work out. Popped above the zone, stopped out, and I lost what I risked on it. You can also see the swaps was still $1,200. Imagine if this trade took 4 weeks and I was paying like close to $1,200 per day. Which actually, no, that was Wednesday, so it's triple. So let's say it's like $300 or $400 per day, right? If it's an average of even $300 per day and I have to hold that trade for an entire 30 days, you do the math. $300 a day times 30 days. That's a lot of money, right? It's thousands of dollars that you'd be paying in swap fees, but I avoided that. And instead I took this loss, which was nicely managed, even on the worst day to hold a trade, which was Wednesday, because I had a good entry and because the entry was at the zone. So if you win whenever you enter a trade right at the zone and it bounces, you win quickly. But even if you lose, you still win. Why? Because whenever price goes to the stop loss, right, you're out of the trade really quickly and it wasn't that big of a deal. Now you have your capital free and your margin and leverage and all that stuff available to be able to allocate it to the next trade that is a really good entry. So even if you lose, right, you win because you're not sitting in the damn trade for like a month. It's beautiful, and all you have to do is just wait for a really good entry. So that said, my vote for you is that you wait for really good entries and you wait for price to get into zones where price is likely to bounce immediately, and then you structure your trade by just putting a stop loss right past the zone and a target below the zone. You'll have a better risk structure if you do this. You have a trade duration that'll be significantly shorter. You can, if you want, have asymmetric risk reward, and this is even if you're using a 1-to-1 risk reward ratio to start the trade off, because you can just close it early if it starts to not work and just hold it to the profit target if it wins. Now statistically you're making more on your winners than you lose on your losers. You'll have a higher risk per trade if that fits your risk tolerance, because you don't have to risk 1% of the account per trade. Now you can risk like 5 to 10% or even more per trade, right? Trading's risky. Most people lose money, so only risk what you're comfortable with, but you can if you want to. I do that. I doubled an account over the course of the past 2 months, and I'm not doing anything really complicated. Anybody with half of a brain can do what I'm doing if they just take the time to learn it. It's very simple. There's not a lot of super crazy in-depth complicated trading analysis I do, right? Price gets to a weekly support or resistance zone, I just buy or sell with a stop loss right past the zone and target of a 1-to-1. Again, I teach all this in the free training video, and it's comprehensive and it's completely free. That's in the links in the description. Just go join that free training course, so that way you can be able to learn exactly what I'm doing here and you can do it for yourself. And then what this culminates in is it culminates in you being able to make potentially more profit if you just wait for good entries. Hope this video was helpful. If it was, let me know in the comments. If you want to like the video, that would be great, and I will see you in the next one. Cheers.